Okay. Starting now. Let me say this right off the start. Kingdom Advisors made a post yesterday that said there are 1,200 certified Kingdom Advisors in North America now. And that's very exciting. What I wanted to say is that almost 80 of them now are from Canada. So I'm excited to see what's happening with Kingdom Advisors in North America, but specifically in Canada. And that's part of the reason I wanted to do these webcasts in the first place, is to give Canadians an opportunity to hear from other Canadians. And I also want to welcome some Americans who are joining us on the call today as well. So as advisors, we're on a journey. There's no doubt about that. I have journeyed for many years, and part of that journey is to bring together the sacred and the secular. And honestly, it's very easy for us to keep them separate, to live our secular lives and then to live our sacred lives and not have the two meet. But the reality is, we all understand that biblical wisdom works, and biblical wisdom is part of the sacred piece of who we are, and we need to bring the two together. So my guest today is Jim MacGowan, and Jim is from Nova Scotia, from the Halifax area. And I first met Jim, believe it or not, it's almost 2 years to the day that we met in Jonathan Lewis's office. And I recall the conversation that we were having that day. It was just a small group of us. It was only 4 or 5 or 6 of us in the room that day. And but what a great conversation. And one of the focuses was around that very idea, the sacred and the secular. And so I'd love for you to jump into the conversation here, Jim. Introduce yourself. Tell us a little bit how long you've been in the business. But first of all, comment on that whole concept of sacred and secular and how it impacted you.
Well, thanks very much, Lorne, and thank you for having me. Yeah, I thought that was a life-changing conversation for me. I had really, I'm early in my journey in terms of Christian life, I'd always separated the secular practice from my Christian values, and they're emerging. And I suspect many people on the call are much further along in the journey than I am. And so you'll bear with me as I move through it. But those words, bringing the two of them together, really resonated with me. And over the last several months, I'm starting to do that, and I'm starting to move through this journey in a very, I guess I'm a little late to the game, but I'm at the game. I've been practicing tax for the past 36 years. I was up until a month or two ago, I was a partner with Deloitte, and I focused on private companies and shareholders and tax planning for high net worth individuals. So that's where I spent a lot of my time. And as a result, I came into contact with and evaluated many insurance products. And I know that that's what we're going to spend some of our time talking about today.
Yeah, and it's exciting. And let me say, Jim, we're all at different places on the journey. There's no doubt about that. And I can tell you now that there are some that probably are arm in arm with exactly where you are right now today, trying to figure all of this out, because it's not easy. And that's why I tend to refer to it as a journey. It's not having a light bulb moment, it goes off and you're there. It's a process. It's something that we all walk through. So tell me as well, or tell us, I guess, you've been 36 years now in this. So why did you focus in the first place and on having tax as part of what you do?
Yeah, and I think we've got some slides to go through as well. Maybe I'll get you to turn to the first slide.
The next one. And Jim, I love your title, by the way, just to jump in, The World According to an Accountant. I've never been able to figure that out because I've never been an accountant. So I think we're in for a treat today.
Yeah, well, we're a strange breed, to say the least. So if we go to the next slide, I focused on insurance because I came to the conclusion pretty quickly that insurance is widely misunderstood. It's not misunderstood by just accountants. It's misunderstood by most people who are not actually practicing in the field. And so I wanted to make sure, as I started to realize that my clients, more than anything else, uh, they have a need, and that need usually includes some form of insurance planning. And so I realized I had to get trained up to speed, and really become comfortable with that. I've also seen insurance as really the next frontier of basic tax planning. I see it as a real opportunity, and I've gotten to the point now where now I'm practicing on my own. I'm spending about 25% of my time looking at insurance proposals, meeting with insurance advisors who are keen to have their proposals reviewed by clients. And so I'm spending about 25% of my time on it. So it's a major part of what I do because, quite frankly, it's a major component of what my clients are looking for. So, um, and I do have my own views in terms of why insurance is so valuable. And again, I'm a little bit in the minority when it comes to accountants when it comes to that. For the most part, the insurance lobby is strong. It's healthy. It's well respected by the government. Today's high tax rates, which will only get higher as a result of the next budget, looking for tax shelters, effective tax shelters, particularly insurance policies that are basically supported by the government. Those are very attractive things to look at. This government over the last several years, and will continue to do so, they're curtailing some very basic planning. And so I see this as an opportunity to use some of the tools that are in front of us. The fact that many of these permanent policies, there is virtually, practically speaking, no limits to what you can contribute to this tax exempt environment. That's all the better. That just means that it's simply like a TFSA with virtually no limits. The other thing, and for those of you who spending time in tax, you'll realize that the federal government took a swipe at really increasing taxes for states back in 2017, and that's coming again. Make no mistake about it. And I think we'll end our conversation with that. And insurance represents a great way not only to fund that ever-growing tax liability, but also to possibly reduce it. And the last thing I'd leave you with is, in terms of an investment, and I'll refer to whole life policies first. If you take a look at the dividend credit rate, although it's coming down, it's still significantly better than most fixed income instruments, and it's in a tax sheltered environment. So as far as an investment goes, it's a pretty darn good investment. So there's lots of good reasons why insurance is attractive. And quite honestly, I'm being contacted by a lot of insurance advisors who, quite frankly, can't convince their clients because the clients are saying, well, you've got a self-interest in this. You're earning a large commission to sell it to me. And I usually come to the file with the perspective of, look, you're going to pay for me anyway, whether I like it or I don't like it. So I probably am somebody that you should listen to. So that's why I find insurance attractive.
Because I know on the call today we have a lot of insurance advisors, and I know the case is, and I'd love to ask you, Jim, how did you get so? You seem very educated in the area of estate. Not just estate, but on the insurance side, which I think is a bit of an exception, wouldn't it be, for accountants? When I think accountant, I think somebody crunching numbers and not necessarily doing a lot of the planning that you just spoke about. Can you comment about a little bit of your journey as how you arrived there?
Yeah, well, I'll tell you, it was quite simple. Clients asked. Clients are being pitched insurance strategies all the time, and they're coming to me as a trusted advisor and asking for my opinion. And I really needed to have an opinion. And we're going to talk a little later about what the accountants are really thinking when they look at your proposals. And I suspect the insurance advisors will find that very interesting. But I just found that if I was to give solid advice either to buy or not buy a particular product, I needed to educate myself. And so I spent a lot of time learning about it. And the more I learned, quite frankly, the more impressed I was. And I'm a little shocked, quite frankly, that the government allows the insurance industry to do some of the things that it does, which is a good thing. And so it come out of a necessity. My clients, particularly what I would refer to as my perfect clients, the ones that I want to be dealing with, they are being asked about insurance all the time, and they're turning to me and saying, help me. And so I spent a fair amount of time learning, and I've come across the good, the bad, and the ugly, if you know what I mean.
So how did you build your practice, Jim, as a secular advisor when you look at it? And we're going to talk a little bit about sacred and secular and how things are going to change, but you can certainly address the question.
Sure.
How did you build your practice to start with?
Sure. I'm a big Dale Carnegie fan, and I believe in those teachings, and I've used those extensively. I believe in focusing 100% on the client, and that sounds trite, and it sounds like everybody does it, but most people don't. And so I spend a lot of time understanding what the client's needs are and putting myself in the client's shoes and really listening to understand. There's a difference between listening to respond and listening to understand. And for the first part of my career, I would listen to respond, and quite frankly, I wasn't responding to the questions. So I had to spend more time listening to understand. And once I did that, I realized that I need to really have a crystal clear knowledge of what the client is looking for, what their problems are, and whether I can solve them or not is not the issue. It's to understand the problem. And the benefit of being a partner at a firm the size of Deloitte is that if I didn't have the solution, I could guarantee somebody in the firm did. I also very clearly learned that I had to understand, what does success look like from the client's perspective? Not from my perspective, but from the client's perspective. What does success look like? And make sure that I have a good understanding of that. And then the last thing is to make sure that there's a burning platform. There has to be a burning platform. If there's no itch, then there's no need to scratch, if you will. And many insurance advisors and other people selling services, accountants as well, they don't, they essentially come to the client, tell them they've got a problem, and then try to sell them a solution. The better tact, I find, is to allow the client to articulate the problem. So the client needs to understand that the client has an itch. Because if the client doesn't believe he or she has an itch, he's not going to look to scratch it. And setting the burning platform is absolutely critical, particularly with dealing with accountants, because accountants, they're skeptical. They're not sure there's a reason to buy the insurance. And so those are some of the key tips. I've also spent a lot of time focusing on what I refer to as first things first. So there's a very big difference between being busy and being productive. And so what I did in my practice is I identified the 3 things that I needed to focus on to be successful. And it's pretty simple: clients, targets, and people. And in that case, I was getting about 80 to 90 emails an hour in my final years at Deloitte. And I basically made the determination, if my email didn't relate to either clients, people, or targets, I was going to ignore it. And I do believe that if you focus on first things first, you'll lead to success. And with that, you also have to measure the results. Effort doesn't matter. We're not in kindergarten anymore. And if you're not getting the results that you want to get, and those results targets are reasonable, change what you're doing. You're not going to get the results you want unless you change what you're doing. And lastly, and I want to reiterate it because it's so important, the client has to be able to articulate the problem that he or she has. If the client doesn't think they have a problem, why would they buy? So they need to understand the problem. You need to create a burning platform. You need to essentially create the reason why they need to do something. They need to take action, because most clients, and accountants even more so, are happy with the status quo. They're happy with the status quo. They don't want to change it, because from an accountant's perspective, the only time they get sued is if things change. So they're happy leaving things the way they are. So if you can show them that the status quo is not sustainable or not attractive, that's how you create the burning platform.
Yeah, that's interesting. One quick question, I guess, is a point of clarification. What's the difference between clients and people when you mentioned in your talk there?
Staff.
Yeah.
Staff.
Okay.
Yeah.
Okay. So staff and clients is really what you're. Yeah. Okay.
Yeah.
And one other question: why do some pundits just categorically say never buy whole life insurance?
Because they're wrong. They're absolutely wrong. And I'll tell you why they're tainted with that. I'll tell you, a lot of pundits just look at it and they look at the commission. They go, somebody getting paid that amount of money, there's got to be something wrong. And look, I have seen my fair share of proposals that make no sense, that the only person benefiting from the proposals are the insurance advisors. And so, a few bad apples really ruin the whole bushel. And I've seen that. But you have to look at the particular situation. But for somebody to make the general statement, never buy whole life insurance, they simply don't understand. They simply don't understand. And they haven't got past the concept that paying an insurance premium is not a cost. It's an investment. It's a redirected investment. And that mindset shift is very difficult to change, particularly in accountants' minds.
So do you feel you're different in the accounting world, or are there lots of you out there like that? Because the concept that I have more when I think about an accountant, particularly when an insurance policy is proposed, it's like there's more likelihood the accountant may shoot it down as opposed to support it.
Oh yeah,
Can you respond a little bit to that?
Yeah, they absolutely will, because their bias is to say no. The only time an accountant is going to get into trouble is if he says, yeah, you should go and spend hundreds of thousands of dollars in paying premiums. Their view is the only way I can get in trouble is if I support the policy. If I say no and it goes away, nobody's going to sue me. So their bias, unfortunately, is no. And most accountants don't understand insurance well enough, and they're not prepared to be taught the insurance by the person making the commission, and they don't want to be taught in front of the client. So there's all kinds of reasons why accountants won't do it. And to be honest with you, that's why I'm fielding calls around the country, because most accountants, they don't even open their mind to it. And so I'm being called by insurance advisors actually to be the accountant whisperer, if you will, to be the one talking to the client's advisor about some of the things that they should consider and why this might be a good idea. It's funny. One of the things I say to many a client that I'll meet with is, some of the richest families in the world own permanent insurance. And if you just look at Canada, the Bronfmans, the Thompsons, the Pattisons, they all own a lot of permanent insurance. They're not wrong. There's a reason why they do that. And maybe it's time to look at those reasons and decide whether it's right for you. May not be, but most people, you need to open their eyes first.
Yeah. One quick question that's come in, and I want to kind of drill down a little bit on the questions. I don't believe we've been able to resolve our slide issue, but I think let's have a fun conversation here and run with that. So that's good.
Sure.
What's the most important thing? And I know this is something we had planned to talk about later as opposed to sooner, but let's jump to it. What's the most important thing in earning an accountant's trust, would you say? Because you talk about a little bit, how do you, I guess, develop the relationship? But a big part of that relationship is the trust element. So how does an advisor build that?
Well, I think you got to start with, you first got to understand that the advisors don't get the accountants they want. They get the accountants that are thrust upon them. I mean, it is what it is. You don't get to pick your dance partner. And I think that's important. It's absolutely critical that you spend time focusing on what the client's needs are and bringing value to the situation. And here's the problem, and I'll be very trite, but to be honest with you, it's true in many situations. I've met many insurance advisors where it doesn't matter what the problem is, the answer is always insurance. That doesn't help your case. So asking the why questions and understanding what clients need in terms of and what their issues are is very important. And accountants can sniff that out. If they see this is just a ruse to sell a life insurance policy, they'll sniff that out. So a very good advisor, whether they're an insurance advisor, an accountant, a legal advisor, they should spend time on understanding what the client's needs are from the client's perspective. And I usually start with this is the fact pattern. If you don't do anything, this is what's going to happen. Do you agree that this is the likely scenario? And if they say yes, then the next question for them is, are you happy with that? Because if you're happy with that, guess what? They don't have an itch, so there's nothing to scratch. Most cases, though, they're not happy with it. And so you need to create the burning platform. You need to ask the questions of the accountant. You've got to show that you want to build value and you want to solve the client's problems, whatever they are. And some of those problems aren't solved. Guess what? They're not solved all by insurance. So if you're seen as an advisor who wants to get to the bottom of the problems, you need to focus on the why questions before you get to the how answers. You need to understand that. And if you do that, that's extremely important. And at the end of the day, if the client or if the accountant can't articulate the reason why they need to buy the insurance, you're never going to sell. So they have to believe that there's a reason to buy the insurance, right? And you need to engage the accountant early, because if they're always behind the scenes, accountants, it's easy for accountants to naysay something when they don't have to look the advisor in the face. And so engaging the accountant up front, because it allows you to better understand their perspective, and more importantly, their knowledge of insurance, so that you can assess how easy it is for them to evaluate and how capable they are to evaluate. And it also will allow you to determine how best to evaluate, how they might evaluate the policy. Accountants are skeptical of insurance advisors, primarily because they're jealous of the commissions, to be straight up honest. They don't see how the insurance advisors earn the commissions they make, because they miss the process. They miss the entire piece of it. And instead of focusing on the value that the client receives, they're focused on the compensation that the advisor receives. And that's part of the problem.
Yeah, I like one of the things you said there, Jim, particularly is the accountant doesn't want to be educated in front of the client. And I think that's a mistake that's often made. There's a lack of communication up front, and if the accountant needs educating, then it needs to be in advance and separate from the client meeting.
I'll, at the risk of saying something that might offend some in the call, accountants tend not to be as bold. If they were, they'd be lawyers. So they tend not. They tend not to. To say many accountants have an inferiority complex is far too extreme. But they tend not to get out on a limb and talk about things they don't know anything about. Which means if there's an area they don't know much about it, they don't talk about it, and they don't provide advice on it. Or if they do, it's always the safe advice, which is, the example I'd use is if I had a friend who was a CRA auditor, and I said to that auditor, "Hey, can I deduct this?" I can guarantee you that answer will be no, because the only time the auditor gets in trouble is if he says yes. So the default is always no. That's the best analogy I would give.
Yeah. Quick question on your typical client in regards to net worth. So like what's the net worth of your typical client? And I need something to put his comments in perspective. No.
That's a great question. So I got to tell you, I mean, after 36 years, and I love my time at Deloitte, but one of the reasons why I left is I get a lot of satisfaction out of dealing with smaller clients. And I would do that kind of on my spare time, because quite frankly, it was more rewarding than dealing with somebody that has a massive wealth portfolio. So I really, at this stage, you reach a stage in life where all you want to do is actually make a difference. And so I don't really have a limit. I think, if you've got clients who have net worth of in excess of a couple of $1 million, then they probably have some of the issues that I tend to deal with. But you'd be surprised. I was on the phone with somebody this morning whose net worth was under $1 million, but they just needed a 15-minute kind of coaching session in terms of one of the things that they were looking at. The nice thing is those people, quite frankly, need the advice more than the others. And so I don't really have a limit anymore. I used to when I was with Deloitte. Most people, when they're looking at insurance, they have net worth north of $1 million. And I deal with some clients whose net worth is close to $1 billion. So it's a wide range.
So I want to drill down a little deeper, because there is a question that come in about, you mentioned the why questions compared to the how questions. Can you provide some examples of the why question? And I think this is some part of your journey that we started out with, is really getting into the why a client would do something as opposed to how. It's easy to focus on the how. I mean, that's the technical side of the business, but the why is probably the more important side of the business that we need to drill down deep. So some examples.
Well, I'd start with the fact, by asking those questions and seeing where people spend the money, you're going to understand their perspective, and you're going to understand where they stand in terms of the spectrum, in terms of Christian values. But to be honest with you, most people, and this goes back to kind of the Dale Carnegie principles that I believe in, most people accept others' actions on face value. And they say, well, the person's doing this, which must mean that. and they draw the assumption as to the reason why people are doing things. A very good advisor asks the why questions because they want to know what motivates the person to do what they do. Because what they might find is there are several ways to achieve the same goal. But most advisors, particularly those who are only interested in selling a product, they don't care why. They don't care. All they care is that the person is doing something, and as a result, there's something that they can sell. But if you spend the time and ask the why questions and you get to the underlying motivation, you're in a much better position to give strategic advice, because what you're doing is you're satisfying the true itch, right? The client, I guess to draw that analogy even further, the client has satisfied this so-called itch that you don't even know about yet with a certain scratch, which may not be the most effective way to do it. By asking the why questions, you're sending a message to the client. Look, I care about you and why you do what you do. Because if I know why you do what you do, I can help you to look at all kinds of solutions, which may or may not involve tax advice. It may or may not involve insurance advice. There's nothing more that builds credibility in the eyes of an accountant than when an advisor comes in and goes, you know what? I'd love to sell you some insurance, but you know what? Right now, you've got to deal with family governance and succession. And here, I think you should speak with this person because that's your burning platform. You need to deal with that. Nothing builds credibility more than when you don't sell something.
Mm-hmm. So one comment that's come in, and so I'd love to get your feedback on this. And we do have a few accountants on the call today. I can tell you that. So some colleagues. So this is from an accountant, and he says, my bias is based on experience with proposals that have been pitched to the wrong clients for the wrong reasons. Often they are not high net worth or ultra high net worth who in my mind are the clients best suited for the insurance or an investment. So yeah.
I think there's a lot of truth to that. I mentioned a few bad apples ruin the bushel, and sometimes there's more than a few. And so it has turned a lot of accountants off because it's just obvious that it doesn't make any sense. A lot of accountants ask for competing proposals so they can compare two, because it's tough to evaluate a proposal on its own. But in that situation, I would say to you that it's clear that the advisor hasn't asked the right questions because they haven't determined that there's a need for the insurance in the first place, or that the problem that is trying to be solved can't be solved in other ways. In many cases, there's a lot of ways to solve, whether it be a tax liability problem, an estate allocation problem. There's all kinds of ways to solve it, and insurance may be one of the solutions, but is the only solution. Insurance are a lot like tax advisors, of which I'm one. We're hammers looking for a nail, right? And so the more you demonstrate that behavior, the more an accountant is going to say, look, you haven't looked at whether this is a good fit. You're the square peg trying to fit into the round hole. And once you do that, your credibility with the accountant is gone. You're not getting it back. So I would concur. I'm as I say, about 25% of my time is spent with insurance advisors. Not all of them like me anymore because in some cases I've told them what I think of the strategy they put in front of them, and they haven't necessarily liked what they've heard. But the client has appreciated somebody who isn't getting paid a commission to do this. In fact, it's funny. Since retiring, I've had several high-end advisors come to me and encourage me to become licensed. Which is appealing for a variety of financial reasons, but quite frankly, I like the fact that I can look a client in the eye and say, I don't care whether you buy the insurance, you're going to pay me either way, and that gives me a level of credibility with which even the most altruistic and high integrity insurance advisor has difficulty positioning himself, because there is a commission involved and there is a self-interest element.
Yeah, a couple of comments as well. Normally, accountants want to wind down their client's holding company after retiring and leave the RRSPs for later. The typical reason is to take advantage of the refundable dividend on tax on hand. If there is a reason to leave the corporation intact and work at drawing down the RRSP. So we're getting into some technical, and we certainly can get into some technical detail here. But and there's another, I don't know if you want to address that, or jump to another question?
It's up to you. I think it depends on the situation, because the holding company can be a vehicle, particularly used with insurance, to make the value disappear on death. The one thing about RRSPs is, to my knowledge, there's no way to make that disappear on death. And you can bet that this next budget will see significant tax increases, and it's only going to make it worse on those people with significant RRSPs. I think it depends on the situation. The tax shelter afforded RRSPs is very valuable, and you don't want to lose that. But quite frankly, I've used some strategies where I've drawn down some of the RRSPs, and I've used the holding company as a bit of a safety valve, because the challenge with the RRSP, if they're large enough, you also lose your old age security as a result. And so every year you're losing the $7,000 or $8,000 that you would otherwise get. And so there's a few strategies that you can look at. Some involve insurance, some don't, but it depends on the situation.
So, Jim, do you see you've just transitioned now, and you are transitioning back to the why questions? And I have a comment from Dwight, who's with Manulife, and he says our company has been delving into behavioral economics to find the why answers. And I guess posing the why questions is significant, because I wonder if we've jumped the queue and we've gone to the how before we've answered the why.
Yeah, I think you're absolutely
and the
right.
why is so significant.
Well, I think particularly as you start to look at a biblical worldview, and you start to look at Christian values, and you look at the importance of faith and legacy, and the enduring journey, there's a lot of things at play here. And by not understanding the why, you can't get at the underlying driver of this. In many cases, there's great scripture around, giving your wealth away, the parable of talents, that, it's all God's in the first place. And I came into the world with nothing, I leave with nothing, and it's all his in the meantime. There's a whole piece about charitable giving that I think as Christian advisors, we can engage clients in that quite frankly doesn't involve insurance. And I think it's, if you want to be a trusted advisor, you need to look at the why questions, because the how answers may or may not involve what you sell. And the best thing, in my view, if you can be a trusted advisor, what it does is it allows you, when the time comes and they really need to buy the service that you're offering, they're more likely to say yes, because they've seen you guide them in an area where you've suspended your self-interest and you've focused on what's important to the client. And sometimes the client doesn't even know. What I find interesting about the why questions is most times the clients don't even answer them completely. And so it's not good enough to just ask why, but talk about, okay, what are you trying to achieve? Was it successful? And you can start to distill. Most people, human behavior is such that they'll do something because they're trying to solve a problem, and they will jump to the solution that is either the easiest or the one they think of first. There could be several solutions, and I find asking questions allows you to broaden your perspective and notice that there's not just one solution, but there's several solutions to this, and then you can get a broader answer. Like I say this about insurance. I see insurance as a good solution to at least part of the problems most of the time. Not all of the time, but most of the time. The challenge I find with some insurance advisors is it tends to be the solution all of the time. And that's where it starts to suffer, particularly with accountants, who some of them may find themselves in a position where, I've got some pretty good tax strategies and I can get rid of most of this tax liability, so I don't need the insurance for that reason. And so recognizing that, and this is what I love about insurance and why I spend so much time on it, it is a very, very powerful tool. Sadly, it's misunderstood, but it's very powerful. I used to joke with my colleagues in the US. The insurance lobby is like the gun lobby in the US. Very powerful, very well respected. And regardless of how you feel about the gun lobby, the insurance lobby holds a very special position right now with the government, partly because they don't understand it. But it still means that there's a powerful tool that is supported by the legislation. And if used properly, can achieve great things. And these great things can be great things for God's kingdom. It can be making charitable gifts. It can be making gifts now as opposed to later, making larger gifts. So there's all kinds of great things that can be done, but you got to ask the right questions first.
Yeah, and on that note, Jim, glad you brought up charity. Here's a comment and a question within it. My experience with successful clients is that they don't give much to charity. Have you considered how to thread in a giving side to your proposals? So there was another comment there, but my screen instead of giving money in taxes to the government, basically, which makes a lot of sense. Yeah.
Absolutely. I usually start with, I do something called a strategic tax review where I look at most of the material, personal and corporate. But the first hint is whether there's any sort of charitable giving in the will, because that indicates that there is a charitable aspect to their view. And then the discussion is, look, if you don't need all the money that you have now, why wouldn't you give the gift now? And I position it from the position of the charity, because I can tell you they could use the money now more than they could use it in 15 years, particularly if you know you're not going to need it. And not only that, but what I don't say to them is if they make the gift now and they see the impact that the gift has during their life, even if it's an anonymous gift, they're more likely to give more because they've seen it. For those that don't have, that don't have the charitable aspect, I also start to weave in questions as to, and you got to be careful not to be judgmental. The questions would be around, I understand there isn't a charitable aspect to your estate plan. What do you plan on doing with your money, and why is that? Why are you doing it? There are significant tax advantages to making charitable gifts, and there's products out there, these flow through shares and so on, that can make the actual cost of the gift very low. And then you take into account the tax savings that come from it, not only just the typical tax savings, but if you use insurance to fund it, you can actually multiply your gift many times over. So those are the conversations that I usually get into. You have to be careful with clients who don't have a lot of charitable giving in their will or in their plan, because you don't want to come across as judgmental. But when you start, fundamentally, everybody's the same. You need to answer the question, what's in it for them? And if you can show them that by making a charitable gift, there are things that are positive, and they don't have to be financial, they can be all kinds of things, then it opens the door to charitable giving. And it opens the door to this concept that you and I have talked about, Lorne, wealth transfer versus estate planning. And wealth transfer focuses on stewardship and making sure that if you're going to give now as opposed to later, if you can afford it, and educating the next generation on the importance of wealth. And if you take the principle that God owns it all, then how are you going to be a steward of that wealth, and how do you plan on using that wealth to make this world that we live in a better place than when you arrived on somebody's doorstep?
So is this, how do you see the biblical wisdom that you are slowly but surely gradually receiving? How do you see it changing your advice, or has it changed it even already, to clients, just generally speaking? What are your thoughts on that?
Yeah, it's funny. I spend, again, I go back to Carnegie and these answering questions, asking the why questions and being more strategic. I tend to focus my perspective on faith, yes, but legacy and certainly an eternal perspective. And what I tend to do is I tend to try to use a biblical worldview and this whole concept of God owns it all. And so, you've been entrusted with this significant wealth, and this becomes a responsibility and to some extent a burden. And most high net worth people feel that burden. And how do you want to change the world to make it a better place? And it allows you the opportunity by not only your behavior, by the questions you're asking, and by the financial advice you give. My hope, and I'm starting to see it, is even my most secular clients are starting to consider a different way of dealing with their wealth, and a different way, a different perspective. And they don't, I see it as almost sneaking up on them when it comes to Christian values. But I believe you lead by your actions, and by asking these questions and posing scenarios, it allows people to step back and go, yeah, you're right. And it's them who has to make the final call. But what you're doing is you're planting the seed. And most people know that, it's always easier if the other person comes up with the idea. They're more likely to be bought into it. And so it's a matter of planting the seed and providing this biblical worldview that allows people to see the bigger picture and not just, I'm just here to save tax. No. I'm here to steward this wealth either to others less fortunate, to the next generation. But this is about making the world a better place by virtue of having this wealth.
Yeah, and I hope those of you who are tuned in today can see the practical and the professional advice being merged with the spiritual, and making the spiritual piece, the stewardship piece, as part of your practice is so vital. It's so important, because when it comes together, your level of fulfillment as a financial professional just increases, because you're helping others steward well the resources that they're given. And I think that's kind of what you're saying, Jim. That's the power of when this biblical wisdom gets infused into our hearts and spirits. It begins to change us from the inside out. And so that's kind of what I wanted to say, because we've gotten into some of the technical stuff here today, as well as the spiritual element. But the merging of the two is where this really gets, in my opinion, I'll say sweet. So just a comment from Steve, or a question, I guess. Would an ideal approach to be to prepare a comprehensive financial plan for a client as a first step, then all the solutions and strategies or products flow from that? What would your thoughts be on that?
I think absolutely. I think the key is the financial plan comes from asking the right questions and really understanding what the client wants. I do a similar thing called a strategic tax review. And what I do, obviously, it's more narrow than what you're speaking about, Steve. But I spend most of my time gathering information and then presenting the facts to the client. I have a lot of strategies that I would like to recommend, but I start with the facts, and that's what the financial plan does. These are the facts. These are the facts. We all agree on the facts. Then I think the next part of the discussion, and this is a very important part, because you need to create the burning platform. Because if people don't believe they have to change, if they can maintain the status quo, they're going to do that. If you could say, look, if you do nothing, this is where you're going to end up. You happy with that? Is that the fulfillment of what your life's work should be? Is this how you would like to be seen? Because if you do nothing and you keep going on this path, this is where you're going to be. And the client may be particularly okay with that. But most clients aren't. They want more. They want to understand more. And what it does is it jolts them out of the path of status quo. And it says, okay, I've got to change something. I don't know what I've got to change. I don't know what the best path is, but I know that the current path isn't the way I want to go on. And so running the financial plan, I think, is a good start. But that's only the start, because that engages you in the next question, which is, all right, are you happy? Are you happy with where it's going to end up? Are there other things that you want to achieve now that you know that you have more than enough to meet your lifestyle needs? Is there something in particular that you'd like to do? Do you have a charitable intention? How are your children? Are they ready to accept this wealth? If there's wealth you want to pass on to the next generation, it's all about asking those questions.
Mm-hmm. So you mentioned, Jim, about whole life, and a close brother or sister, I guess, to whole life would be universal life. Any comments on that, the practicality of using universal life versus whole life?
Yeah, I think absolutely. I think it makes a lot of sense in some situations. Sometimes the numbers are better. It depends on what you're trying to do with the policies, whether you're trying to build cash surrender value, whether you want more flexibility in terms of your investments. I did find, interestingly enough, the nice thing about being old is that you remember things. Prior to 2008, universal was all the rage. And what I found is after the financial crisis in 2008, it swung drastically to whole life. because it was seen as more conservative. And I do believe that the whole life policies certainly have a place, and it is something that I would definitely look at, particularly with some of the tax planning strategies that I like to put in place. Whole life is good. Universal life can actually be better.
Yeah. Okay. Good. Quick question here. Any recommendations on software or illustrations to use to help clients understand the overall concept better? When you're looking at whole life, corporate owned, that sort of thing in your practice.
Yeah. I think the simpler the better. I had a great illustration that was given to me a few years ago, where it showed that under certain scenarios, with some of these whole life policies in particular, if you take a look at taking that money and simply putting it in a fixed income instrument, after the government takes its 50% share, after 10 years, and you look at the amount of tax you would have paid had you done that, which is the status quo, versus putting in an insurance policy, you can actually show that the cost of the insurance is essentially covered by the tax you would have otherwise paid anyway. The illustrations are interesting because I think for most insurance advisors, you got to keep it high level at the beginning. The client has to understand at a high level what you're trying to achieve. And I wouldn't spend a lot of time focusing on the capital dividend account, because you're dead. Clients don't care. That's exactly what I tell my clients. Like, you're dead. So yes, it's nice. It's gravy. But let's talk about what the insurance policy can do for you now, whether it's a state allocation or whatever. So I keep it at a high level. And what I do is I focus on the best insurance advisors say, based on my discussions with you, here are what I hear to be your major concerns. 3 or 4 major concerns. Do I have those right? Yes, you do. Okay. Here's how I believe insurance can help solve 1, 2, 3, or 4 of those major concerns. And by the way, I've also given some thought about your other concerns, and I think you probably need to speak with this person or that person, or engage this type of specialist on that. It shows that you care more about the person than you do about selling the product, because they've got 4 concerns. And I'm interested in more than just the concern that will get me a commission. I'm looking at all of the concerns. The illustrations themselves are interesting because I've looked at a lot of illustrations. Once you get to that stage, the good accountants will look at the underlying assumptions and whether they make sense. And I'll give you a perfect example. So, the dividend credit rate for certain policies is higher than others. So certain whole life products with certain companies, it's sitting north of 6%, and others it's sitting at 5%. And dividend credit rates are going down. Anybody who knows insurance knows they're going down. And, the first thing that I get worried about is if I see an insurance proposal, if it's Canada Life and they're showing 5.1 or 5%, or it's another company that's showing 6.25, I'll push back. But what I'll really get concerned about is if they don't show that dividend credit rate -1 or -2, because I can tell you for as surely as I'm sitting here today, dividend credit rates are going down because of interest rates and because of the lag in the performance, even with their alternative investments. It doesn't mean it's not a bad investment, because those dividend credit rates are still a heck of a lot better than the 1% I'd be getting in government bonds. So the underlying assumptions in the illustration are absolutely critical, because they go to the credibility of the advisor for sure.
No, that's great. I appreciate what you shared. There was a comment about the capital dividend account, and I loved how you expressed how the need for addressing the need of the client, or the interest in the heart of the client and their desires. That's where the focus needs to be. And I think for the advisor, many times it's so wrapped up in the product and trying to share the value of this product, which centers more around the numbers as opposed to the need. So I really appreciated that.
Well, and I would say this, the product doesn't need all of the bells and whistles to be proven as being a very effective tool. And people try to go too far. And so the CDA is a perfect example. I've seen these. This is the effective return, assuming you die at age 80. And it always takes into account, mostly takes into account the capital dividend account, which is great. But I know very few clients. There are some, but I know very few clients who care about the capital dividend account, because they're dead. if you focus on what does it do?
Right.
I had a client who was heavily involved in real estate, and his goal was that he wanted his boys to get the real estate. Well, he needed to give something to the girls, and he was going to have to give the girls real estate, and then they were going to be arguing with the boys about how to deal with the real estate. His solution was he needed a state allocation. Insurance provided him a way to give the girls, in this case, cash, and the boys the real estate. That was the problem he wanted to solve. And yes, the capital dividend account is the cherry on top. That's great stuff, and I wouldn't ignore it. But what does the client want? In this case, the client wanted the family not to fight, right? So this is a good example of how you really got to get underneath the motivation. The client, if you asked the client, he would have said, well, I just want to give the real estate to the boys and then be able to run the real estate unencumbered, not having to listen to their sisters. But that's not what he really wants. What he really wants is family harmony. He wants to treat his kids equally, and he wants to maintain family harmony. That's what he wants. So you've got to continue to ask the question, because most people don't even truly understand what they really want. And that's the beauty of insurance. Many times when you get to the underlying goal of the client, insurance is one of the viable solutions. It may be the most viable solution, but it's usually one of the solutions worth considering.
Question that we didn't cover earlier that Trevor put on, and because I missed it, he added it again. So I definitely want to cover it, and then we're going to kind of wrap this up. What do you believe is the spirit of the ITA allowing the insurance to be tax-free? Is it related to the fact that insurance companies help people during disasters, death, illness, disability, etc., and that this cost would be far too much for the government to take on?
Yeah, I think that. Look, I don't think the government understands insurance at all, quite frankly. It comes from the premise that insurance is there to meet a need, whether it be a family that needs the insurance to maintain a lifestyle after a loved one is gone, or pays a tax liability that would otherwise be debilitating. And cause the liquidation of generally illiquid assets. I think that's the principle. What's happened, and it'll be interesting to see when and if the government catches up, it's being used for so much more. You're seeing this all the time, and you're going to see more of it. You're going to see a lot more leveraged policies out there, because it's a way to get the money out tax-free before you die. And that's really what's happening there. And you're really taking, and the theory is, look, the life insurance proceeds are tax-free anyway. If I borrow against the life insurance policy, I'm just getting my death benefit early. Why should it be taxed? That's true, but it's based on the fundamental principle that the government sees life insurance as a tax-sheltered, advantaged investment. I'm not convinced they're there, but I don't think they understand it well enough. And quite frankly, they've got bigger fish to fry right now in terms of things that they need to solve. So I believe insurance has a fairly long runway, but there's a lot to it, and a lot that can change that might. I mean, we may have a chance to end with some topics on the budget, but with the amount of spending in the budget, there is no question that we're going to start to see significant tax increases, and he's going after the 1%. And he's going after the people who are dying, because guess what? The dead don't vote. And so insurance planning is that much more relevant now than it ever was. And you're going to find that as we get closer to, and we see the kind of changes that are coming about next April, insurance as a viable alternative is that much more important.
Mm-hmm. Yeah, that's good. That's a good wrap-up comment. But I do have a couple of questions in regards to, are you licensed in different provinces to work on cases? If so, without being too specific, what do you charge? And off topic, but have you ever been told you look like comedian Bill Burr? But better looking, of course.
I've been told I look like Ed Harris. So for those of you who remember Ed Harris, he's kind of a B-list actor. So people say that I look like him. You don't need to be licensed per se to provide tax advice. And I'm actually providing advice to clients right now in BC, Alberta, Saskatchewan, Ontario, and then all of the Atlantic provinces. And so it depends on the situation. I'm lucky in that I'm not in this for the money. And it sounds corny, but it is really true. And so I'm glad to take phone calls and talk to people kind of on a no names basis, just to see if there's an opportunity to help out. I've had some insurance advisors who just can't get their clients past the point that the premium is a cost. It's simply a cost, and I don't want to pay that cost. And they're not interested in leveraging the premium for various reasons. I've actually had a lot of situations where I've actually gone into the clients and I've done what's known as the strategic tax review. I've identified a bunch of tax savings. I work with their existing accountants. We implement the strategies, and then the tax savings are used to pay for the insurance because it's a windfall. So it varies in the situation, but I'm a big believer, quite frankly, that any first meeting needs to take place with no meter running. It allows me an opportunity to get to know the client or to get to know the advisor, and to make sure that there's a good fit, because this is personal stuff. We're all professionals here, but when we're talking about somebody's mortality and we're talking about how they're going to, how their family is going to be treated, that is very personal stuff. And so I'm a big believer that you need to meet somebody, meet an advisor, get a feeling as to whether you're comfortable with the way that advisor acts and reacts to certain situations before you make it. So my view is you have the first meeting, the meter doesn't run, and then you decide how and if I can help. So the important thing, I've done a lot of accountant whispering, because accountants tend to listen to other accountants more than they'll listen to insurance advisors.
Yeah, that's quite interesting. I've heard of a horse whisperer, but that's a new one on me.
Accountants can be as stubborn. So
yeah. So I do want to thank everybody, and our time is just about done. There are a couple of questions, Jim. If you can hang on, I'd love for you to address these questions, but I want to thank everybody. If you have to go, I thank everybody for joining us and taking the time today. But there are a couple of questions that I would like to have addressed as we wrap up this afternoon. And one is this: what are your thoughts on allowing a market to sell policies to allow people to access funds or prevent them from lapsing? So, yeah.
I looked into that, and I'm actually looking into that as a possible investment for a client of mine in Nova Scotia, because viaticals are allowed in Nova Scotia. They're not allowed in Ontario.
Right.
Viatical settlements have come with a lot of, I think, some urban myths in the US in terms of what people do once they know they've got a policy on somebody else's life. I think it's an area that should be explored. I think you have to be very careful with this. And I do think if it becomes a widespread industry in Canada, what's going to happen is it's going to change the pricing of the policies. Because for those of you in the insurance business, you recognize that the great majority of policies lapse. I mean, people wonder how insurance companies make money. Well, that's because most of the policies lapse. And if the likelihood of them lapsing goes way down because people are willing to pay the premiums, it's going to change the pricing for all of us. So I think it is something worth looking at. Nova Scotia is small enough; it's not going to make a big difference. But you start to have some of the larger provinces allowing it. You have to be careful about nefarious players in that business, and you have to be careful with what it's going to do to the pricing of the policies themselves. It's a great question, actually. It's one I'm looking at myself.
Yeah, very good. Do U.S. residents who are beneficiaries pay tax on a death benefit?
You know what? I can't answer that off the top of my head. I can't answer that off the top of my head. I tend to focus on the Canadian. Usually, U.S. residents buy U.S. policies, so that's not something I spend a lot of time on.
Okay. And one final question: do you look at old policies and identify the opportunity to do an AOR change and max what they have already?
Yeah, absolutely. I do. I mean, many of these policies have been priced pretty well because the pricing has changed more recently. And so we do take a look at all options, and some of those options aren't buying a new policy, but actually just making changes to the existing policy. So, we look at this again. We look at it from the perspective as what was the insurance? Here's the question I'd ask: why did you buy the insurance in the first place? And does the need still exist? Yes or no? And regardless of the answer to the second question, what are your needs now? what is the point now? I mean, I've got a client right now who's looking at buying a ridiculously large policy, and he's likely going to sell his business during his lifetime. The insurance advisor isn't really focused on that. And I said, look, if that's the case, then you don't need the insurance because you're going to pay the tax during your lifetime. You might want to buy a policy so that you have a tax shelter vehicle that you can stuff some of these proceeds into. But it changes the question altogether. So ask the right questions before you go to the solution. That's a solution. It may be the right solution, but ask the right questions around the reason for the insurance and what the situation is now and whether they need more, less, or any insurance.
That's great. That's wonderful information that you've provided today. I know, Jim, lots of people are probably going to be wanting to reach out to you and connect.
And Lorne, if you want, I'm more than willing. The slides were brilliant, by the way. If you want, I'm more than happy for you to share those slides with the audience. We jumped all over the place, of course, but if there's any value to the slides going out to the audience, I'm glad for them to have it. Information. I mean, this is, as I say, was less about a marketing pitch whatsoever. Yep. But to be honest with you, I think speaking for the accountants on the call, our lives are made easier the better the interactions we have with insurance advisors, because quite frankly, the clients win in the end. And at the end of the day, that's what's most important.
Yeah, absolutely. And I will definitely provide the slides. That's, I think, easy enough to do. Hopefully we have no technical glitches with that. And I apologize. This is the first time we've had this kind of technical issue before we started. Jim was trying to get on for probably 15 minutes. So it was just an issue which I think threw a monkey wrench into our plans for the day. But I definitely enjoyed the conversation. I think there's lots of value here. And again, it's a mix of the secular and the sacred coming together so we are able to operate as we ought to be as kingdom advisors. And ultimately, our goal is to be better ministers of the kingdom in the work that we do every day. So, Jim, thanks so much, and look forward to doing it again sometime.
Excellent. Thank you for having me.
Thanks, everyone, for joining us today.
Take care. Bye-bye.
Bye.